Well, I can't say I didn't warn ya. The Fed has raised rates by 75 basis points, and the stock market is actually rallying, unlike what many people had expected going into this meeting. So in this video, I want to first of all give you guys an understanding of why this has happened. Why is the market going up when the data and the chances of a recession are still relatively high? And following that, I want to explain the big talking points from the Q&A session from Jerome Powell's meeting today, because there is a lot we have to unpack. There's good news and there's bad news. And there's also some critical data about how aggressive the Fed might be over the next few quarters, which will most certainly drive the stock market either to the upside or to the downside. So it's very important that we analyze that data. And then finally, we're going to look at the summary of economic projections itself to understand what are the expectations of the entire committee. And we're going to also look at the S&P 500 stock chart to see whether or not we could be going into a rally mode over the next few days. But again, before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So the first thing we want to understand is, why did we raise by 75 basis points? Well, the simple answer is the inflation data for May came in much hotter than expected. And the Fed has said this multiple times that they are going to be data dependent, meaning they care about headline CPI and core PCE to make the decisions of interest rates. And especially on Twitter, I'm seeing a lot of people not really understand how this works or why this is the case. As you can see, people are making memes that the Fed is not trustworthy or that this should crash the market, right? Because the 75 basis point hike was not expected last month. Well, the simple answer to that question is that in May, inflation was much slower than in June right now, because CPI data lags by 1 month. And so I think this is a pretty unfair assessment to make of Jerome Powell and his committee. 75 basis points, in my opinion, is actually good. And the reason for that is because it shows us that the Fed is indeed trustworthy to a certain extent. Guess what? Over the past 6 months, people have been extremely uncertain about what the Fed is going to do. And that is precisely why there's so much volatility around these FOMC days. And so if the Fed is now more certain about the path of inflation, right, and that we're not going to go into a runaway situation, then there is a lot of hope for the market, in my opinion. And if the Fed is already being aggressive by raising 75 this month, 75 next month, and then potentially 25 in September and December, then that is going to be more aggressive with inflation and should help inflect it going into the end of this year and potentially start of next year. And that is precisely what's going to keep the stock market higher. Inflation is the number one thing that's concerning investors today. So it's very important that we keep in mind the Fed's actions. Now, following that, the other thing I want to discuss is, why is the Fed being so slow when it comes to their updates on recessionary data? Recession was not even a word Jerome Powell mentioned in today's meeting. The Q&A section is what brought up the recession. And the simple answer to that, from what I understand from what Jerome Powell said, is because recession is not actually a situation we're in today. According to him, that's his words. He's saying we're not in a recession. He's saying that the recessionary talk at the dinner table is primarily being driven by oil prices. And because of that, consumer confidence has gone down. And because obviously the stock market has also gone down significantly and real estate is starting to inflect, that is the main reason why we're seeing inflation expectations go up and consumer confidence go down, which in turn is obviously increasing the expectations of a recession happening. And so the good thing here is that Jerome Powell seems to have a higher level understanding of the macroeconomic situation that's driving the market. And I've said this multiple times. On paper, we are in a recession this quarter, but chances are that this recession is not going to last as deep as many people are expecting, because the underlying labor market is already starting off at a very strong footing. And Jerome Powell has said that given the strength of this economy, this 75 basis point hike and the interest rates we're going to experience by the end of this year might not even have that big of an effect on the economic growth of this country. And we're not even seeing any sort of economic slowdown, because people are taking credit and they're spending money like crazy out there. And that should bode well for stocks in the longer term, even though in the short term, the market is very scared and there's obviously a lot of fear around what the recession is going to happen and inflation data. And as you can see, the stock market clearly likes that assessment, because it takes away a lot of the uncertainty that people have been talking about. And now I'm going to pull up some of the notes that I took from the Q&A session. And these 2 points I want you guys to listen to very carefully, because this is important. Even though it sounds very subtle when Jerome Powell actually mentioned these specific quotes, these are important because these are going to be the main driving factors of stock market movement over the next couple of quarters. Specifically, Jay Powell said that progress in inflation will show up eventually, and that historically inflation has always fallen very aggressively, even though it tends to persist for a very long amount of time. So this is a good thing, because obviously inflation has persisted since the summer of last year. That's when inflation started rising. And so basically what he's saying is that if inflation starts flatlining, and the Fed is going to be flexible in that, and they're going to be patient, then we could be very near that inflection point where we start seeing the monthly CPI headline readings start to inflect. And I can guarantee you that by that time, the stock market could have already potentially bottomed. Because like I've said multiple times in the past, the stock market is a forward-looking indicator. The market is always looking 6 to 12 months ahead. So right now, the market could be pricing in the rate hike that's going to happen in September and in December. Obviously, if inflation stays at where it is right now, and that doesn't lead the Fed to be more aggressive to maybe a 50 or a 75 basis point hike. But again, with the economic data we have right now, the market is already pricing in the pain we should technically experience in September and December of this year at those FOMC meetings. And then secondly, the important thing Jay Powell also mentioned is that inflation could come down even faster than expected, at least on the good side, because of the current supply chain situation. You see, stocks like Nikola, STEM, my portfolio, which is revolving mostly around hardware companies, right? These companies sell supply chain related components to other businesses. These stocks have struggled primarily because of the supply chain situation, because the cost of raw materials has gone up. And so essentially in the longer term or in the medium term, this could mean that prices could come down more faster than most people expect. Because if demand goes down because of higher rates, and if inventories are starting to ramp up because production for these raw materials is still very high, because obviously the cost of producing them is starting to go down, then that's going to result in a pretty accelerated price spiral to the downside. And that's good for the market. That means that when inflation inflects, stocks will go down, or prices will start going down more aggressively than we've seen, portrayed in the typical economic textbooks. And I think that's a very good thing for the future of the market. And then the other thing he mentioned, which is, I think, not as important because we've already known this for a very long time, is the fact that core PCE, which is that essentially the inflation data that factors out oil and food prices, which is something a lot of people have been crying about on Twitter and stuff, that is a much better indicator of where inflation is going to be than the headline CPI data. And like I said, this month, even though last week headline data came in really bad, the actual data on the PCE side came in not as bad, meaning although it did surpass expectations, the rate of PCE growth compared to CPI growth was not that fast. So from that point of view, we could be starting to get those little bit of signs about, okay, at least on the good side, inflation is getting better. And we've already seen that through Walmart and Target, those companies that reported horrible earnings because inventories are skyrocketing and they have to cut prices. And that is deflationary. On top of that, the US dollar is extremely strong. And as we all know, having a strong dollar is one of the Fed's main goals. And that eases the pressure for the Fed to increase rates even more aggressively to get the money supply even more tight, because the dollar is already very, very strong. And so, in my opinion, this meeting kind of just reaffirms the stuff that we've already known for the past couple of months, except for the fact that obviously inflation came in a little bit hotter. And my thesis about buying the dip and having a little bit more certainty about the market being a good thing for stocks, I think is starting to play out. We'll have to see what happens. Obviously, situations can change, but it looks like SPY right now, which is the S&P 500 ETF, could be bottoming at least for the short term. We don't know if this is the bottom. Nobody knows if this is the bottom. I don't think this is the bottom. I think we could be having more pain to the downside or potentially a movement to the sideways. But at least it shows us that the instant reaction from hedge funds, market makers, and the world for this FOMC meeting is bullish. And it doesn't really matter what happens to stocks over the next couple of weeks, because that's going to be based on new news. at least in the short term, I find this meeting to be semi-bullish. And I again think that it's worth buying your favorite companies as you see deals in them instead of waiting for prices to go lower, because we just never know when the stock market all of a sudden starts pricing in inflation actually coming down. Because Bitcoin, for example, has gone down significantly over the past, 7 months or so. But Bitcoin is supposed to be that inflation hedge. And many people have been thinking, why is this happening? And the simple reason for that is because you see this massive rally in Bitcoin here and here. This was already the inflationary run that we saw in Bitcoin. The people that wanted to buy Bitcoin to hedge against inflation bought here and here, or they actually bought down here, and they sold up here and up here, right? And that is exactly why Bitcoin is going down now, because now Bitcoin's movement is technically pricing in these interest rates that will bring down inflation in the next couple of years. And obviously, if inflation comes down, that's going to reduce the attractiveness of an asset like Bitcoin or Ethereum. And so this is the exact theory that you need to apply to the stock market. Look ahead, look 6 months ahead. Where are stocks and the economy going to be 6 months ahead? If it's going to be extremely poor, which is something we can't really tell from right now, right? But for me, at least, I'm seeing the labor data. I'm seeing the fact that B2B enterprise spending is still very high. And the fact that although inflation is still elevated, core inflation is getting a little bit better because of the supply chain situation that we're in that was happening because of the pandemic. And it seems like the Fed is already trying to price that in with their midpoint target ranges for interest rates going over the next couple of years. As you can see, they're expected to cut rates in 2024 and keep them relatively stable in 2023. And as we all know, cutting rates is very good for the market. And so if the economic situation and inflation was actually going to be very bad, then this chart would look like this. We would have interest rates going up. And that would be that Paul Volcker moment, because obviously in the 1980s, interest rates went up for 5 consecutive years. But in this case, it doesn't seem like that's the situation. It's going to depend on where inflation goes. And although oil prices are relatively high and that's hurting the consumer, at least from a core perspective, inflation is starting to show some signs of strength. But again, we have to see what happens. My bets are on that the market will recover and that buying the dip in this kind of environment where there's a lot of fear is certainly going to pay off. But again, let me know down in the comment section below what you guys think. I think that the market is reacting kind of in line with what you would think from such a report. Jerome Powell's overall tone was a lot more confident in this meeting as well, which kind of gives me a lot of confidence as an investor, because I think that this guy is kind of knowing what he's doing basically, right? And that he is somewhat trustworthy, even though he's made a lot of mistakes over the past 10 months. But regardless, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.